prior to investing.
Well, good morning and a happy July. And this is Greg Farrell, CEO and President of Farrell Wealth. It's a wealth management firm here locally in Valparaiso, Indiana. I'm a registered financial advisor, and the show is Money Matters with Greg. We have a fun show just talking about money, how it matters to you, how we can help you in any way to be able to sort of add some money to your family, so add some value to your family, some ideas on this show. We podcast on Apple, so you can find us Money Matters with Greg on Apple, and also wherever you do find your podcast, as well as Podomatic.com. You can catch us there. Have almost 120 some episodes now, just plugging away as we add more and more. And this is what we do here at WVLP 103.1 FM. I want to thank Greg Kovac, our engineer here today, for running the boards and getting us up and running here on this reasonably nice day here in July. We've had some brutally hot weather, as most of us all have across the nation. We do broadcast here in Valparaiso, Indiana, but we are streamed nationwide and worldwide. So thanks for listening today. Thanks for being a part of it, and always thanks for your ideas and thoughts. You can find us on Twitter at Farrell Wealth. You can find us on the website as well, farrellwealth.com. And get many of the information that we bring to you as far as financial literacy to this show is on our website, farrellwealth.com. And then, of course, you can just email me, Greg at farrellwealth.com as well. I'd love to hear from you and get some ideas. Today, we are going to talk about the mid-year outlook for the market. We have hit the mid-year mark, and I wanted to be able to talk about how we are doing, how we've done, where we go from here as far as your investments and moving forward in the stock market. We usually talk the stock market for all those that are new to our podcast. We talk the stock market usually about the first 10 minutes or so. Talk what's going on in the markets, gives you an idea, and then we sort of break it out into different topics as far as financial literacy. We've had just recently 15 apps that will help you save some money. And we also talked about healthcare costs, being able to help you with your healthcare costs. And that's sort of what we do here in sort of 10-minute segments. So if you are listening to the podcast or even on YouTube, you can find us on our YouTube channel, Farrell Wealth, as well. We do have a green screen, and we do try to do our best to have a production that is reasonable and certainly something you can watch for 20 or 30 minutes long. We try to divide it up into 10-minute segments. So that's what we do here. We're going to talk about the market usually for the first 10 minutes, but today we're going to go all the way through and just give you this update of the mid-year and how we're doing. When we released, when we talked about in January the outlook for 2019, what we really worked on was trying to focus on what really matters in the markets in December 2018. Now, if you remember, 2018 was awful. The financial markets were in disarray. You had the worst October of 2018 was the worst in 10 years since 2008, and the worst December since all the way back to the Great Depression. So global investors were a mess and very scared by the uncertain monetary policy that was going on, the fiscal and legislative discord, the slowing economic growth, and slackening corporate profits. Despite this whole mess of volatility that we had, we still really firmly believe that the market and the economic fundamentals remained generally sound. And let's relax here, try to figure it out, and try to back up a little, even though it was pretty ugly. Now, fortunately, the worst of these fears did not materialize, and the consistent and really kind of consistent with our outlook and consistent with our ideas, U.S. economy avoided a recession, which was looking like it was pretty much imminent. Global equities rebounded. The fixed income returns really contributed to many diversified portfolios. Economic market fundamentals were the foundation really about the market's recovery from that December low. And even though we have been facing prospects of periodic volatility with international discord and international issues, we believe emphasizing on the fundamental really remains critical to have an effective investment decision, an effective investment philosophy, to just hold tight. If you do your homework and you invest well, and you have confidence in the fundamentals, then you will hopefully be rewarded as time goes on. So now, halfway through 2019, the U.S. economy has held steady, supported by fiscal stimulus that we've really had over the last 2 years. Corporate profits continue to grow. At the same time, trade tensions are increasingly weighing on the economic outlook, which has been a mess, but we're hopeful that slowing global growth and political uncertainty will really force the global central bankers to extend extraordinary levels of support, still navigating a very challenging environment. Investing comes with uncertainty, and market volatility can be alarming at times and keep you up at night. But we can continue to encourage you as an investor and many of the people we speak with in regards to our wealth management firm to just encourage investors to look beyond short-term market stresses and consider real drivers of investment returns that we really believe that will be the key to achieving financial goals throughout. So with this mid-year outlook 2019, I hope it provides sort of an updated view of the last 6 months of current fundamentals, things we should persist as shorter-term concerns fade, an emphasis of 4 pillars for fundamental investing, 4 main pillars. One would be policy, one would be the economy, one would be fixed income, and one would be equities. So as the headlines change daily, these 4 pillars are going to stay the same, and that's what I wanted to be able to talk about today. So let's talk, where are we now? Let's talk about policy. We believe that fiscal stimulus from the Tax Cuts and the Job Act of 2017, along with decreased regulation, increased government spending, are going to continue to help the U.S. economy in 2019. Potential impact is both larger and more durable than consensus expectations, and we'll see at the time, at the same time, uncertainty around global growth continues to dampen the benefits of fiscal support. Now, we still believe self-interest is likely to bring the United States and China back to the negotiating table, which has already started. But until we see some sort of progress, trade tensions remain a primary risk to the forecast. It is weighing on all of us, not only here in a local environment with the farmers that we are our neighbors that are attempting to make a living through the weather and to be farmers and to do what they do, but also with the steel plants, with the different tariffs that everyone's trying to figure out if they're on, if they're off, what they are they 10%, are they 25%, how it all works as far as a business. It's very difficult to plan if you don't necessarily know what your costs are. So fiscal policy is definitely taking the lead. Monetary policy grew more supportive in the first half of 2019. The Fed Reserve indicated earlier this year that they would likely hold on interest rates, raising interest rates for the rest of 2019. And this is partly in response to the market's poor reaction to last December's rate increase. Thanks for that, by the way. But with inflation low, global growth slowing, trade risks still present, monetary policy may be too tight for the current environment. I mean, you just start going on all these different things as far as policy goes. Even if not fully justified by the data, the Fed may choose to lower interest rates later this year to provide a buffer against increased uncertainty. So I've been very, very critical of our Fed chair and the Federal Reserve. October and December, in my opinion, did not have to happen last year, and so they correct their conversation or correct their wording, and suddenly we're up this year, and now we have to cut to slow things or to get things ramped up again, which is it's just interesting. If they would have held pat and changed the language, we would have been just fine. But as far as the economy goes, U.S. economy growth is in the first quarter was better than expected. with early readings showing that gross domestic product or GDP growth was about 3.1%. Now, data certainly has weakened in the second quarter, but there are bright spots that still remain. Labor markets, consumer sentiment remains upbeat, and consumer spending continues to be an important driver of growth. Manufacturing, however, has seen a larger impact really because of trade. We still see and believe fundamentals are supportive of the moderate GDP growth this year. And again, progress on trade concerns is central to those growth projections. We've seen a slightly reduced GDP reduction from the 3.1, 3.2% to more of a forecast at 2.25 to 2.5. What about inflation? Well, we believe that the current pace of growth is consistent with an economy that's really able to generate solid demand without adding excessive pricing pressures. So we'll see how this all affects in regards to the tariffs, as far as your costs going up for those goods that you want to be able to buy from IKEA or wherever. But consumer inflation has slipped as global demand has softened, sort of outweighs the broader price impact from tariffs. Today there was an announcement from a number of different banks, and the Deutsche Bank news was huge in regards to them cutting 18,000 jobs and changing their entire business model. That is an enormous bank changing things up, and how that all affect the German markets and our markets is still sort of up in the air today. But while the headline inflation data really remains sluggish, wages and wholesale prices continue to grow at a healthy clip. So back to the fundamentals, keep an eye on the fundamentals. As much as you might hear differently on this show, you'll hear the truth and try to figure out exactly what you can do in regards to your investment philosophy. We expect core price index, or the CPI, consumer price index, which excludes the food and energy prices, to grow at 2 to 2.25 for the year over year in 2019, and that's on pace for what it did in 2018. If you go into fixed income investors have really benefited from falling rates due to subdued consumer inflation, a pause on rate hikes, and demand of U.S. Treasuries. You've seen a flattening of the yield curve, which we've talked about on the show multiple times in regards to the inversion and what that tells us. But we believe the flattening is due more to global investors searching for better yields than it is the indicator of a looming recession. Considering the Fed, inflation, and our expectation for progress on trade, really look for the 10-year Treasury yield to reach 2.5 to 2.75 range in the next 6 to 12 months. That's up from right about 2.07, 2.09 right now. We definitely can favor an emphasis on investment grade bonds and fixed income allocations, with the focus on a balance of corporates and mortgage-backed securities as well. I believe the extra yield in that MBS market, the mortgage-backed securities market, given the degree of risk, remains attractive, and economic growth continues to support investment-grade corporate bonds. So keep an eye on those. That's just basically what we're thinking, what we're doing. Overall equities, I have to say that overall the U.S. economic picture supported continued expansion. Modest inflationary pressures have helped boost the demand and really support corporate profit margins in the first quarter. So really solid fundamentals. Continue to believe that corporate profits will exceed consumer expectations. Market valuations are still favorable. You always wonder, are things overpriced? With the S&P 500 index forward 12-month price to earnings ratio, or PE ratio, within historic norms. We reduced our S&P 500 earnings per share of the EPS forecast to $170 for year-end 2019, mainly because of the trade uncertainty, and our year-end S&P 500 fair value estimate remains at 3,000. So keep an eye on that. We'll see at the end of the year if we're right or wrong. We'll certainly hold ourselves accountable as to how that looks, but we will revisit that forecast and sort of a clarity on trade, monetary policy result, and more of an impact on corporate profits. But policy, let's talk about exactly some of these things that kind of go through and that really affect the overall market. Central bank driven monetary policy and legislatively driven fiscal policy really provide the backdrop against which businesses and consumers operate. Even though businesses drive much of their own success or failure, they're really always adjusting to policy environments. We're constantly back in the yin and yang, or bobbing and weaving, however you want to look at it, where consumers are constantly nudged by policy, whether though through interest rates, whether through tax policy, overall job market, you name it. That is something that we are directly affected with monetary policy. Now, monetary policy has dominated much of this expansion that's happened in the last few years, last 10 years. Fiscal policy increasingly has impacted businesses and the overall economy. So fiscal policymakers use four primary levers to support economic activity. They are taxes, regulation, spending, and trade. Now, the first three levers remain tailwinds for economic growth and corporate profits. Trade, however, continues to dampen the benefits of those other levers. So trade is affecting the other three. Fiscal stimulus via the Tax Cuts and the Jobs Act of 2017 really provided a boost to economic activity in 2018 through tax relief for consumers. Now, we still believe that the fiscal support for the act will exceed consensus expectations in 2019. And fiscal policy contribution to real GDP growth should be about 2.2% for 2019. That's higher than the 1.3% contribution in 2018. So reduced regulatory burdens as well have increased business investment by energy companies, while looser capital standards have boosted the lending capacity for the U.S. financial companies. And over the past year, U.S. corporations have repatriated approximately $750 billion of foreign source profits, providing additional funding for shareholder distributions, hiring, capital investment, R&D, you name it. So trade and tariffs and the deficit. Look, unfortunately, the benefits of these fiscal measures may not fully materialize given heightened trade uncertainty and the fight that we're picking with many of our trading partners. Too many businesses have faced questions about cost. Too many businesses have faced questions about logistics. Supply chain management is the conversation of many CFOs throughout the nation. And many shareholders want to know, what are you doing in regards to your supply chain management? Are you taking them out of China? Are you adjusting? Are you adapting? I mentioned this show just a couple weeks ago about Giant, the bicycle company, from the minute President Trump said something about trade in China, they changed everything and believed what he was going to say. They were one of the ones that adopted a change, and they've moved much of their almost 100% building and their supply chain from China to other places throughout Asia. Now, trade negotiations with China hit a stalemate in the middle of May. That was why we had such a bad May. We were down almost 6% in the month of May, with the Trump administration responding to these increasing tariffs to 25% from 10% on $200 billion in Chinese imports, and threatening tariffs on, remaining on this other $300 billion. It just sounds like we're stuck in a Michael Myers movie with all of the billions being thrown around here. But China retaliated with additional levies of 25% on $60 billion in U.S. imports, and threats of non-tariff barriers. In addition, the U.S. planned to impose tariffs on Mexican imports, really roiled the markets in May. That was quickly resolved, but that was a long weekend. Nevertheless, businesses are increasingly concerned that a new front of the trade war will sort of appear at any time. Who knows? We'll see what happens. But in addition to trade, we really remain concerned about the level of federal deficit spending, and a glut of U.S. Treasuries has really been issued over the past year to fund government spending under the assumption that there will be a consistent bid for U.S. debt. Now, although there's a strong bid for Treasuries now, that demand may wane as inflation nudges higher. Global investors sort of begin to demand more yield amid the rising federal budget deficit. So we do not believe legislators or global investors fully appreciate the long-term risk of a rising deficit to domestic rates and the value of the U.S. dollar, adding complexity to the policy outlook. If it were up to us, we'd certainly like some of this deficit to be paid down, and that would be very appreciative to not only us, but to our children and our children's children. The Fed's role in a perfect world, in a transition really of leadership from monetary policy to fiscal policy as a leading global economic catalyst, would have gone smoothly in the perfect world. But in the real world, a variety of challenges has surfaced, resulting in this further reliance on accommodative global central banks rather than feuding fiscal legislators. Even in the United States, monetary policy is still part of the story. The Fed raised interest rates 4 times in 2018, and in retrospect, 3 hikes probably would have been sufficient, back to my whole conversation about my angst in regards to October, November, and December of last year. And given the market's poor reaction in the 4th hike in December, it's pretty easy to see that the lesson learned was the Fed indicated earlier this year that rate hikes would likely remain on hold for the rest of 2019. Now, not surprisingly, investors in risk assets rejoiced and loved this Fed decision. So with inflation low, yield curve indicating monetary policy may be too tight for the current environment, the Fed may go further and choose to lower rates later in the year to provide sort of an insurance policy in the cuts, the mid-cycle insurance cuts in 1995, 1998 that we're seeing, which was now occurred, really some solid growth backdrops. So we'll see. But policy decisions can be confusing. They remain central to our economic and market outlooks. We really continue to believe that the economic and political self-interest will bring the United States and China back to the negotiating table. And until we see some progress, though, the trade uncertainty is the primary risk to not only our forecasts, but many forecasts that are out there. In regards to the economy, fundamentals really have continued to support to be steady. Moderate economic growth in 2019 has continued. Like I said, I mentioned a 3.1% growth. And GDP has probably been lowered by us, certainly, but down to 2.25 or 2.5. Jobs and productivity, even though we see growth slowing, the U.S. job market continues to be the bright spot. Hiring's continued at an above average pace for the expansion. Weekly claims for unemployment benefits have dropped at a cycle lows really several times this year. And strong job growth leads to higher incomes, stronger businesses, and consumer spending, and improved corporate profitability. Productivity growth, though, is the key to sustaining this virtuous cycle. And we saw a glimpse of this in the first quarter as productivity grew from the strongest pace since 2010. So that's really good. You've got to be able to see the hiring signs all over, not only here locally in the Midwest, but as I travel throughout the United States, I see many help wanted signs, people looking for productive, solid employees. You can find work if you are willing to work here in the United States. Higher productivity becomes primary driver of economic growth, and with that comes that sort of an economy of near full employment. That also lifts profit margins by boosting output and lowering labor costs. Trade uncertainty is becoming an increasingly risk to productivity supporting business investment, and really countering a boost from the pro-growth deregulation and tax relief. So you're seeing this sort of fight between the two right now. Overall, let's talk about global economy as we will kind of walk into the last 5 minutes of the show. Global economy, even if revised downward, the U.S. growth expectations have been holding relatively well. Europe, in particular, still faces a variety of political economic challenges. The United Kingdom's Brexit process is still messy. It's been messy from the start and continues to unravel. France has continued to be this sort of, will continue with the Yellow Vest protest. Germany's battling weaker manufacturing. Italy is struggling with difficult budget negotiations of an unsettled governing coalition. Trade concerns also may remain in play for Europe, with important trade discussions in the United States on agriculture and autos still sort of outstanding. These structural issues have also impacted the monetary policy outlook, with the European Central Bank and the ECB pushing back plans to raise rates and reduce the size of the ECB's balance sheet. All right, then let's just talk in Japan. Programs to increase government spending. However, the consumer sentiment also weakened ahead of overall value-added tax increase scheduled for the fourth quarter of 2019. And though Japan's recent GDP growth has exceeded expectations, really suspect that a higher activity comes at the expense of growth in subsequent quarters in the future. In regards to emerging markets and the other markets that are left that we haven't talked about, set pace with global GDP, Beijing's intervention has stabilized demand in China, but the trade uncertainty continues to weigh on confidence and investment in regards to emerging markets. Still see the United States as a growth leader in the developed market, but emerging markets continue to play this increasing role in the global economy, with the pace of growing growth leadership shifting from China to India. So that's basically our overall talking about the four different pillars. We talked about equities, we talked about fixed income, and making sure that even though the economic environment has become more challenging, these four pillars of fundamental investing hold dear. You've got the policy, economy, fixed income, and equities, and they still appear sound to us. We really still continue to monitor the impact of trade developments on the indicators that we watch. For now, the odds of a near-term recession still remain low. U.S. stocks may endure periodic volatility as the bull market ages, but we encourage investors to focus on this long-term trends instead of short-term noise. Volatility is the blessing and curse of long-term investing, and during volatile periods, it can really be tempting to become emotional, short-term decisions that could conflict with long-term goals. Also, you have to really consider viewing bouts of volatility as opportunities, when suitable, when falling within your investment philosophy. The rebalance portfolios towards long-term allocations is paramount. And focusing on the fundamentals, we really believe we all can make prudent and effective decisions about how to achieve our long-term goals. That's my mid-year outlook. That's our mid-year outlook from Farrell Wealth and LPL Financial as well. LPL Research is who you can follow. I'm going to put this outlook up on the website. You can get it from there. You can also email me, greg@farrellwealth.com. I'd be happy to email it to you as well. It's about a 12-page report, and I just want to be able to kind of summarize where we've been, where we're going, give everybody an idea here in regards to July 2019. The show's Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrell Wealth. It's a wealth management firm. I'm a registered financial advisor. We talk money on this show. I want to thank everybody for being with us today. Thanks to everybody that's listening on podcasts and also out there in the social media world. We're on Facebook, we're on Twitter, we're on LinkedIn, and of course you can always just email me, Greg@Farrell Wealth, with anything you like about any questions you might have. I hope today was a help. I hope we added some value to you and your family in regards to your investment philosophy and where to go from here. It has been an extremely volatile last 12 months. From July of last year to July of this year, we have been on a very up and down ride. It has been a roller coaster. And I hope today added some sort of clarity for where we're going to be the next 6 months. Thanks again for listening. Thanks to all of our listeners out there, not only here in WVLP 103.1 FM, but also worldwide on the stream at WVLP.org. And thanks to Greg Kovach for running the show. Wouldn't be able to do it without him. And we look forward to everybody having a very healthy and profitable week. We will see you next week.
There we go.